There you go. The Reserve Bank of Australia fired the first hawkish shot today, raising its cash rate by 25 basis points to counter renewed inflationary pressures there, just as oil prices remain volatile amid Middle East tensions. Oil, on the other hand, retreated from yesterday's peak levels, but situation in the Middle East looks all but settled. As such, we are expecting to see more hawkish announcements from global central banks around the world that we'll be meeting in the coming days this week. A part of the hawkishness is already priced in, so the question is, could that help improve sentiment? We will see. So welcome to Swissquote's Daily Market Talk. It's Tuesday, 17th of March. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So the early spike that we saw at the weekly opening bell in oil prices faded throughout yesterday's trading session, pulling both US and Brent crude below the $100 per barrel psychological mark on news that a few tankers could actually transit through the Strait of Hormuz yesterday, now open to countries outside the United States, Israel and their allies. The US President also told CNBC that the US is now letting Iran ship its oil to ease pressure on global oil prices. But of course, the continued tensions there keep oil bulls well away. The WTI crude is slightly higher again, above the $95 per barrel level this morning in Asia, while Brent crude is about to return to above the $100 per barrel psychological mark yet again, and the geopolitical outlook remains very much uncertain and dull, making oil and energy prices more keen to rise further than fall for good. On the geopolitical front, while Donald Trump's call for international help received a chilly response from once reliable allies and China as well. And what to say? It's been more than a year now that allies have been threatened with softer military support from the US. Earlier this year, the Europeans had a chill around Greenland as well. And Donald Trump's administration imposed massive trade tariffs on partners as well around the world, pressing local economies to such a degree that making such geopolitical decision to send warships to the Strait of Hormuz today, alongside with the US, has become a monstrously complicated political decision to make. Now, make no mistake, Europeans also want resolution more than anyone else, and they're exploring options outside the context of NATO, some of which consist of rerouting trade, for example, through the Red Sea as much as it is possible, but nothing is clear just yet. What's clear is global uncertainties persist, opinions diverge, oil infrastructure is being bombed in the Middle East, and Russia is filling its pockets thanks to the easing of sanctions on its own oil. There are now even talks among Europeans that they should normalize their relations with Russia because, well, it's soon the gas refill season in Europe and the Qatari LNG is compromised. No wonder the European defense stocks gained 1.79% again on Monday's trading session. So the question is, could this get worse? Well, if you add in the private credit stress that weighs on big banks around the world, the AI stress, the SaaS apocalypse, the hawkish shift in global central bank policy rate expectations, and the waning international trade and military trust, well, it doesn't necessarily set the stage for euphoria. But there will be a trigger for bringing the dip buyers in again. Remember post-Liberation Day rebound? All parties are worse off today than before the tariffs hit last year, but the markets still rally toward all-time high levels. So I expect easing of the Middle East tensions to trigger a similar kind of optimism, but the news headlines will obviously decide when and how. And while today the news remain unideal really, the Reserve Bank of Australia today raises cash rate by 25 basis points as expected to counter the renewed inflationary pressures there that are about to get just worse with the rising energy prices amid the Middle East war. The Aussie dollar rebounded from its 50-day moving average level yesterday, but that was basically on the back of a broad-based US dollar retreat and approached the 71 cents mark today, probably also helped by some good news from the Chinese economy. And elsewhere, the US dollar's retreat yesterday gave support to major currencies as well. the euro dollar, for example, rebounded off 114.14 level, while the dollar yen saw resistance into the 160 psychological level. But the ongoing Middle East tensions, higher energy prices, and the hawkish shift in Fed expectations remain supportive of the US dollar in the short term. And expensive energy priced in stronger US dollar will force the major central banks to show a hawkish stance this week as well. So what I can say is that the latter is not necessarily looking good for risk appetite this week. So the Fed starts its two-day monetary policy meeting today, and investors can't wait to see how the US policymakers there assess and gauge the latest developments and their policy. The latest dot plot published back in December, remember, was pointing at a median expectation of around 2 interest rate cuts this year from the Fed, as the Fed members were actually leaning towards strengthening the softening jobs market in the US, and that despite inflation stickily running above target. But now inflation is not only expected to steadily run above target, but is also expected to heat up, while the softness in the US labor market remains a concern. So what to do? Is it better to try strengthening the US jobs market, or is it better to first tame inflationary pressures, make sure that there is no problem there, and then take care of the labor market? Well, the economic theory would say take care of inflation first, but if inflation uptick due to the Middle East tensions remain short-lived, then maybe the Fed should just continue to care about the labor market. So the decision is not going to be simple, but activity on Fed funds futures already stopped pricing in a full 25 basis point cut this year. So the hawkish expectations are mostly priced in right now, and that leaves us wondering whether the Fed's announcement tomorrow will be more or it will be less hawkish than what's already priced in by the market so far. The answer will be tomorrow evening. Across equities, European and US markets had a positive Monday session, and they were helped by retracement in oil prices and gains in technology stocks, particularly in the US. Nvidia's GTC conference started yesterday indeed, with the CEO Jensen Huang marking the event by telling investors that he expects the company to reap at least $1 trillion in revenue for its newest AI chips through 2027, adding that he's certain that computing demand will be much higher than that. The next big thing in AI, he said, will be the shift to agentic work. So that's models that are not only answering questions and telling you how things do work, but they actually do the work themselves. And the latter will drive even more demand for powerful chips like the ones Nvidia sells, says Jensen Huang. But it also increases the competition among other big technology companies aiming to make inference cheaper. Think of Google's TPU chips. So that's maybe why Nvidia didn't manage to consolidate its earlier gains and close the session just 1.65% higher between the 50 and 200-day moving average range. Now, Nvidia has actually been trading pretty range bound since last November, hovering somewhere between $170 and $200 per share levels, as investors have little doubt that Nvidia will do just fine as long as big technology spends big. The worry is that investors are less comfortable with big technology's big AI spending today. And as per the SaaS apocalypse, the AI built models threatening the service as a software business. Now, Jensen Huang predicts that the industry is shifting towards what he calls AaaS, agentic AI as a service. And this model, companies would sell AI agents to their clients so that the clients can build their own software themselves. iShares expanded technology software ETF gained 0.90% yesterday on hope that companies could make a smooth transition toward the AaaS model. But the thing is, some will and some will not. So the question is, who will and who will not? So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, with day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.